Today, we're asking a question. If Britain leaves the EU without a deal, will the economy collapse? Will Britain become a small, impoverished island off the coast of Europe? Will food become scarce? Will the dead rise up and the rivers boil over? Will cats eat dogs and locusts plague the land? Are you sure about those last two? Well, okay. Now, Britain's future is its own. There are plenty of successful economies outside the EU, and indeed, there are a couple of failing ones inside it. Whatever happens in the next 12 months, over the longer term, Britain and its continental neighbours will have close trading arrangements. And Britain's economic success or failure will be its own responsibility. But this piece isn't about the long term. It's about the short-term effects of a no-deal, crash-out Brexit on the UK economy. Okay, music time. Think of a supermarket, perhaps Tesco's or Sainsbury's. Now imagine the shelves empty of food. Imagine queues of hundreds of people outside, hungry, tired and cold, waiting for scraps. Now cast that image out of your mind. Britain's supermarkets will not run short of food in the event of a no-deal Brexit. There seems to be some crazy, fanciful notion out there that because of regulations or some such, lorries will be stranded at Dover with food rotting, or that no deal means the EU will erect barriers and cease all trade with us. Neither of these things are true. And if UK regulations somehow prevented the importation of food, which they don't, then the government could, in a matter of hours, rescind them. There are few votes in starving your own population. But this does not mean no-deal Brexit is sunshine and roses. On the contrary, both the EU and the UK will be badly affected by it. This leads to complacency. If it's terrible for both sides, someone will step back from the brink, they say. But that's a poor argument. There are many ways Britain and the EU could end up with an unexpected, no-deal, no-plan Brexit, the most likely being by accident. It happened because we thought it couldn't. So, let's start with tax and some good news. Right now, if a British firm sells into the EU, it needs to collect VAT at the correct rate for the customer. This is a non-trivial process based on multiple levels of confirmations. It's been a bane for small exporters in the UK, and it will disappear post-Brexit. Now for the bad news. There are two EU directives, 2003/123/EC and 90/435/EEC, oh these Eurocrats with their catchy names, which streamlined and in many cases abolished withholding taxes on dividends between associated companies and prevented double taxation of subsidiaries. If a Swedish subsidiary of a UK company paid a dividend, the Swedish tax authorities could no longer charge a withholding tax on the dividend. Now this isn't some great tax scam. If the Swedish subsidiary owes corporation tax, it will need to pay it. But it means there is no presumption of owed tax. Were we to leave the EU in a no-deal scenario, the Swedish tax authorities would fall back on charging the subsidiary a 30% withholding tax on dividends to the parent. Now, there's a certain irony here. You see, these EU regulations apply only to relationships between entities in two different EU countries. Other treatment of dividends, double taxation and the like is an entirely national affair. So unless the process is smooth via a transition where existing EU law applies to the UK, then there will need to be a rapid series of negotiations with individual countries to replicate the existing system. And it's entirely possible that EU firms will avoid investments in the UK and vice versa until bilateral agreements have been reached. Getting taxed twice on the same profits is something avoided by all finance directors who wish to remain employed. There are also issues around transfer pricing, VAT, and around companies that operate in the UK and another EU state but only have a legal entity in one. And there are personal tax issues too. In summary, a no-deal Brexit would leave a lot of companies in limbo. Until bilateral treaties with individual member states are set up, it would strongly discourage investment across the channel for both British and EU companies. Next up, into EU trade and finished goods and services. Here the disruption would be less than people fear. Because the UK and the EU currently have identical standards, there should be limited day one impact in most sectors beyond the requirement to now clear customs. Now, there would be exceptions to this, such as in sectors where certification bodies no longer have jurisdiction, such as pharmaceuticals. However, in all likelihood, UK medicines that have been previously certified would continue to be covered. It's not in anyone's interest for patients to die. The biggest impact would be that a portion of the UK's imports from the EU would now have tariffs applied to them and vice versa. For simplicity's sake, we're going to assume that the UK adopts the EU's tariff schedule, lock, stock, and dairy absurdity barrel, which means a blended average tariff of around 2%. However, this applies only at the wholesale level, and there'll be substitution effects as well, so outside areas such as cars, a 10% tariff, the impact would be small. Of course, there would be disruption. Right now, lorries that cross the channel are barely checked because they're crossing from one part of the EU single market and customs union to another. This will need to change, and people importing via lorry will need to fill out different, more complex cargo manifest than previously. There will be additional transaction costs of additional paperwork, but given the complexities of VAT in the EU world, these will be a relatively modest additional burden. Furthermore, in the short term, the UK could follow the principle of assuming that if a container was on a lorry, well, it had probably been declared. And what of the UK's exports of goods to the EU? Well, that's a harder call. You see, there's a difference in scale here. Imagine a firm in Grenoble in France with 5 suppliers of a vital widget, most of which are in the continuity EU and only one of which is in the UK. Bad behaviour by the French government, i.e. subjecting incoming containers from the UK to extensive screening, would have a negative impact on supply chains above and beyond that caused by tariffs. I'm not saying this would happen, only that it could happen. Okay, what about trade with the rest of the world? In theory, the impact should be modest. In reality, it would be more severe because we would drop out of the EU's existing arrangements. These range from the deep integration through the EEA treaties with Norway, Iceland and Liechtenstein, through deals such as CETA with Canada, to the series of treaties which regulate US-EU trade. Most of these countries have much more onerous tariff schedules than the EU. Take South Korea. According to World Bank data, its blended average tariff rate is 9% against 2% for the EU. That means that a no-deal Brexit would negatively impact demand for British products relative to those produced in other countries. Now, it's reasonable to argue that other countries would seek to replicate EU deals with us as soon as possible, although I would caution this is not simply a matter of scratching out the words European Union and replacing them with United Kingdom. But given treaties usually require ratification, this would take time. There's another bit of irony here. Leaving the EU disadvantages UK exporters to the rest of the world, where tariffs tend to be higher, more than those who sell into the EU. The immediate consequence of a no-deal Brexit, then, may be that we became more, not less, dependent on the EU. Here's some better news. Around 45% of UK exports are of services, and only a minority of these go to the EU. Much has been written about the lack of a single market for services in the EU, but this is a red herring. Creating a single market for driving instruction or haircutting ignores the fact that these services cannot be meaningfully exported. But this is by the by. Few of our services exports, engineering and design, movie and music production, computing services and the like, are subject to tariffs. When you're selling something that only exists ephemerally as ones and zeros pulsing down a fibre optic cable, governments tend to be slow to catch on. Okay, financial services. Short-term impact? Well, there'll probably be a little bit, but less than people expect. Small UK fund management firms with French retail customer bases would be affected, but there aren't that many of them. Hedge funds? They're all theoretically based in tax havens anyway. Corporate finance will probably end up moving closer to customers, and as a longer-term risk, banks will be required to have traders inside the same regulatory block as the capital they're risking. But these aren't day one issues. There would be disruption, sure, but large investment banks have been preparing for some time, and it would affect the users of the UK's financial services as much as the financial services firms themselves. What have I missed? Transport and travel. UK citizens travelling abroad would no longer be members of the EEA and would need to fill out landing cards. There is an open question about whether Germans and Swiss coming to the UK would be allowed to use the same lanes as Brits, as they do now. If not, or if the UK is shut out of the system where data on passports from EEA citizens is electronically verified, then UK airports and ports will have long queues at immigration. My money, however, will be on the system continuing to work as it has done historically, or at least until the UK negotiates something new. Ultimately, it's the choice of the UK government who it lets into the country post-Brexit, and I think keeping things moving smoothly probably wins the day here. There will be unexpected hassles for Brits on holiday in the case of no deal. The European Health Insurance Card, which allows tourists to access local healthcare systems, will likely not work for Brits in the EU, EEA or Switzerland in the aftermath of no deal. And the Spanish healthcare system currently treats many British retirees and then bills the UK. Will the UK continue to pay these bills? I suspect the answer is yes, because it's in the interest of both countries. Now, airlines. I don't know if you know this, but planes already fly between the EU and non-EU countries. The bad news is that the EU has 60-odd arrangements with other countries relating to air travel that we would exit on day one of no deal. The biggest of these is the EU-US Open Skies Agreement, which we would leave and which the US has said it will not replicate for us. This means we might have to fall back on the default US bilateral airline policy, which could affect British Airways. Why? Because British Airways is no longer a 51% British firm. It's now a part of International Airlines Group, along with Iberia and Vueling. And under a standard bilateral agreement between the UK and the US, only firms that are 51% British or 51% American can operate passenger services between the two countries. Longer term, will a proper, deep agreement between the US and the UK be signed? Obviously. But the US airline lobby is powerful, and London Heathrow to New York JFK is one of the most profitable airline routes in the world. Delta, United and American would love to increase their share of the transatlantic trade at the expense of British Airways and Virgin. The need to come to a rapid agreement with the US would be immense, inevitably damaging British firms. Okay, this has been a whistle-stop tour through the problems with a no-deal, crash-out Brexit. None of the issues on their own are fatal, but cumulatively the impact would be severe. Investment levels would drop as firms sought to mitigate the risks of double taxation and withholding tax. There is the risk of disruption to our exports through customs checks, and we'd drop out of a host of existing EU arrangements. Would these be enough to tip the economy into recession? Well, that depends. The UK government would probably respond with fiscal and monetary stimulus to keep consumption levels up. But doing so would further unbalance the UK economy. It may be that we avoid the frying pan of no-deal Brexit, only to fall into the fire of an economy where savings rates reluctantly and eventually normalise. Well, that's enough for me for one video. As I said in my previous piece, the destination is less important than the orderliness of the transition. Thanks for watching, and if you haven't already done so, please click subscribe.